Hello, friends. Today, I want to do a very interesting exercise with you. I want to show you how your tax liability look like depending upon what kind of entity you use. Why do I want to do this? Well, I want to do this because there's a lot of misconceptions out there. I hear all kind of arguments as to why somebody set up an entity. And sometimes those arguments make sense. Sometimes they don't make sense. For example, one of the common one is, well, S Corp is the best entity. Why? Well, because it saves me a lot of taxes. And that answer might be true, or it might not be true. The reason why I'm telling you that is because maybe you heard it from a friend or a family member, or maybe you watched some video and somebody said, well, set up an S Corp because that's a great way to save taxes. And you go do it. And now you're running a payroll. Now you're paying an accountant. Now you got to build a balance sheet. Your tax returns get a little bit more complicated. So you've added a lot of other expenses just to save a couple of $1,000s on taxes, but you thought that you're going to save a lot more taxes. So it would be kind of nice if you have done some math in advance. So that is exactly what I'm going to do today and show you everything live so you understand it completely. Another one that I often hear from people is that, "Oh, by having an S Corp, I get a QBI deduction." That is a huge saving. Now, I don't deny that QBI allows you to write off 20% of your income and not pay any tax on it. That's a wonderful benefit. But once again, just like anything else in taxes, it doesn't apply to everyone. There's always a unique circumstance when it does apply, and many times it doesn't apply at all. So people think they're going to get a lot of discount, but they actually might not. Third one that I commonly hear from people is that, hey, by having an S Corp, I pay less on payroll taxes. Once again, just like I said with other things as well, that is technically true, but we cannot really just depend on that answer only. We have to take a look at the overall tax liability. At the end of the day, you don't really care how much money went to payroll or Medicare or federal or state. You care about how much did you pay out in taxes. So we cannot just look at the one element of your taxes. So that's the purpose of today's video. I'm going to walk you through everything so you can see it live. Now, if you're new to my channel, my name is Deepak. I run a tax firm called Tax Code Advisors. You can reach out to me by going to taxcodeadvisors.com. So obviously I can help you out with your taxes, but I also run a coaching program. So if you're a small business owner, you have rental properties, you're interested in stocks, you're interested in financial markets, and you want to just get better at it, because every single year we get better at finances, the next year is better. We get better ROI on our investments. And I can tell you, every year I learn something new. And when I learn it and I spot the opportunity the next time, it makes me a lot of money. So that's what the coaching program is all about. So if you want to learn about it, just go to taxcodeadvisors.com and reach out to me and I'll show you. And if you are, by the way, part of the coaching program, you get access to me unlimited throughout the year. So you can talk about anything you want to talk about. You also get access to all the tools that I have. You also get access to, daily commentary as to what's happening in market, what kind of things you want to pay attention to, where might be the opportunities, and what kind of things I am doing to protect the downside as well. So you get all of that as part of a coaching program member. All right, so let's come back to taxes based on entity. So what I'm going to do is, first of all, I'm going to start out with somebody who is making $100,000 in income. All right, so let's just copy that number. I'm going to put it here, put it here, put it here. Okay, by the way, before I go any further, most likely you're going to reach out to me and you're going to say, Deepak, what website is this? What software is this? I want to do these numbers myself. So this is something proprietary. We use it in-house. I change it based on my needs because numbers are always changing. The way I do consultation is always changing. The way I want to teach my coaching members, that is always changing. So I want full control over it. So this is not something I publish online or you have access to it, or it's not a software that you can buy online. There probably are, not this, but there probably are other software that you can certainly get. So if you want to get access to this, or if once you become a client or you are a coaching program member, then you do have access to this and all the other tools that I give to members as well. So please, don't ask me what website this is because you're not going to find it online. All right. So $100,000, I'm going to do this math. We're going to keep the expenses at $50,000. So let's stick with that for all different type of entities. And let's see how things look like. So right off the back, you can see right here that if based on that income and that expenses, if you're a sole prop, you're in about 19% tax bracket, S Corp 22, partnership 15, and C Corp 23% tax bracket. So you tell me, is setting up an S Corp makes sense to you? Probably not, right? Even a sole prop is actually better because you pay least amount of tax based on this. But you might say, wait a minute, Deepak, but that's not really true. Actually, I will be making better off if I set up a partnership because partnership is even lower than a sole prop. Actually, this number is a little bit misleading because this is showing a total tax liability of two partners, which is, because it divides that income $100,000 into 50,000. So you guys know that uh, at a lower tax bracket, the situation changes. So to really compare it, what we need to do here is increase the expenses so it matches with other entities. So what we need to do is instead of 50,000 expense, let's make it um, 100,000 expense. Okay, and increase the revenue to 200. All right, voila. So you notice now what we have done is we have a revenue of $100,000, expenses of 50,000, and my net income is 50. So you see all entities are net income of 50,000 now. So now we are really comparing. And now if I compare, you see with a partnership, I get the same number, exact same number as this. See, it's 18 and a half. This is 18 and a half. S Corp is 22. C Corp is 23. So in matter of fact, if you think about it, the S Corp doesn't make sense in this case, and C Corp doesn't make sense. Partnership and sole prop, what makes perfect sense. So this looks actually pretty good. So you see how that changes based on what the income is. All right. Now let's move on. Let's say the revenue is 200,000. How do the things look like now? So we go 200,000, and just so we compare, I'm going to make it 400 so that way each partner will get $200,000 in income, and we're going to leave everything same. For expenses, we're going to leave it the same number. So that way, again, everything matches. See, everything is 150 now for the net income. So based on that, if we do the math, you can see now, well, we can go right here. So you can see sole prop will be about 25% tax bracket, 24 and a half to be exact. And S Corp will be about 22. And then a partnership will obviously same as sole prop, and C Corp will be about 23% tax bracket. So at this income, if I was making $200,000, you will say that, it doesn't really make a whole lot of difference. It doesn't matter. They all are about the same, right? At, 25% versus 21. So yeah, you do save a little bit here, right? 36,000 versus 32,000. So you might say, well, Deepak is still worth it. I don't want to pay extra $4,000 in taxes. True. But see, remember, if you are setting up an S Corp, then number one, you have to run payroll. So if you're going to run payroll, we're going to charge you some fees for it. And that's a monthly fees. So that adds up. Number two, we are going to build proper books. So there will be some bookkeeping involved there. I mean, bookkeeping probably involved in other ones as well. So maybe that doesn't really make a whole lot of difference, but still, we got to add that as an expense. Then the taxes get a little bit more complicated because this will require a specialized tax return. So you have two tax returns instead of having just one tax return. So there's additional cost with that. So you add all that up, and then you go like, you know, most likely you're going to spend $4,000 in all the additional expenses. So it really makes no difference. Almost the tax going to be roughly about the same. It's about $36,000, no matter which entity you set up. So at $200,000, doesn't really make any difference. At 100,000, sole prop was better. Now let's increase to $300,000. And you're starting to see my picture. I'm running these different scenarios for you, so you don't get tricked by somebody trying to sell you some product. Okay. So now I go to $300,000, and we'll see, okay, now we're starting to see some benefit in the S Corp. 60,000 versus $72,000. So that's a nice $10,000 difference. I'll take that as a savings. To be exact, about $11,409. Not bad, right? Even C Corp is better. So in this case, being a sole prop doesn't really make any sense. C Corp is still better. S Corp is still better. We're good. What happens if we increase it further? Let's say 500,000. That means I'm going to have to make it $1,000,000. Okay. And this is 500,000. Now what happens? Okay. So now my sole prop is at 32%. My S Corp is 28, and my C Corp is at 29. So see, once again, C Corp and S Corp is matching at $500,000. Isn't that weird? So see, this whole S Corp theory actually only works in, in if there are a lot of scenarios, like if you put it on, 100 different scenarios, in about 90% of the time, S Corp might not be the right decision. There could be something else. Um, so that kind of gives you an idea there. Let's go more. Let's make it $1,000,000 just for heck of it. See how things really look like in that case. So 2 million, obviously, in this case. I'm gonna keep the expenses the same, not really changing expenses a whole lot. Now, what do you think? Well, in this case, you see actually C Corp has become a little bit better than the S Corp itself. Instead of 32.68, this is about 32.10. So after roughly around $1,000,000, actually C Corp starts to become more attractive than the S Corp. So these, which entity you choose will change based on your income, based on your expenses. So keep that in mind. So don't never hear from somebody that, hey, this is better because I pay less taxes, because you won't be able to figure out whether that makes sense for you or not. All right. Second excuse that I hear from people is about this QBI deduction, this 20% deduction. And people say, oh my God, I'm setting up an S Corp because I get a lot of QBI deduction. Now, those of you guys who doesn't know what the QBI deduction is, basically you don't pay tax on 20% of your income. Now, again, this is only for federal taxes. I'm not talking about state taxes because many states do not agree with that. So they'll say, hey, we don't care what discounts federal government gives you. We still want you to pay taxes on full income. So keep that in mind. So, hey, 20%. So because of this, I want to use S Corp. Okay, let's take a look at QBI. So we are right here, right? So if we go here and we see what the QBI discount I get, guess what? 0, 0, 0, 0, 0. I don't even get QBI at this income limit. And people think they always get QBI. So it kind of creates a confusion. Not everybody qualifies for QBI. Not every business qualifies for QBI, and it gets phased out after certain income limit. So this doesn't really make a whole lot of difference. Okay, let's go back and change it back to, 300,000. And let's see what happens with our QBI. Do we get it then? Okay, same thing. And voila, take a look at QBI. We got $12,000, 2,242, 12,000, 12,000. So we do get that QBI discount in this case. That's pretty good. Okay. But in spite of this discount, you can see what the tax bracket looks like. It doesn't really make a whole lot of difference. So people get all excited about this QBI because it sounds good, 20% discount, but it doesn't apply to everyone. It just depends on each unique circumstance. So I hope you're starting to understand this. It's this a little bit more complicated. I'm really only trying to keep things as simple, but there's just so many other elements. Is your spouse involved in your business? Is it a real estate or a regular business? Is it active? Is it passive? What does your W-2 income look like? There's so many other things. I'm really oversimplifying it, so don't say, okay, this is it. We have to look at the overall situation to come up with which strategy might make more sense for you. But these are the common reasons I hear. The third reason that I hear from people why they want to go with S Corp is they go like, well, if I'm an S Corp, I run a payroll. So in this case, you can see $80,000 a payroll I run. And because I run a payroll of 80,000, I don't pay self-employment tax on my entire income. Meaning if I didn't have an S corp, I'll be paying self-employment tax on $250,000. But now I only pay self-employment tax on 80,000. And on this $163,000, I don't pay self-employment tax at all. This is actually true, right? This is true. But again, it sounds good. When people tell you that, you get super excited. Maybe you watch some video or somebody's trying to sell you some sort of service. You get super excited about it. You go like, yeah, and it is true. But in practical terms, if we actually do the math, we notice right here that we still have to pay Social Security tax. It's about $9,000. We still have to pay Medicare tax. That's about $2,300. So altogether about $12,240. If I was not an S corp, if I was just a regular sole prop, I'll be paying about $29,000. So I can show you on paper that by switching you to S corp, you're actually saving $17,000 in taxes, right? And this will be true. If you do the math, this will look exactly the way I just showed you here. And then I add QBI deduction on top of it, and you'll be like, oh, wow, that actually makes a lot of sense. However, in reality, if you go back down here, you see we paid $72,000 in taxes versus $61,000 in taxes. Okay. And then on top of that, like I said, we have to run the payroll, we have to file extra tax return. So we have to add all of that cost back to this and then see, is this really any better than this? Right. When you're setting up an entity, taxes is obviously one reason you want to do this. But there are so many other reasons that we have to think about that how do we structure it? So sometimes maybe we structure it that we have a partnership and we have a C Corp and we have an S Corp. Sometimes we have all four of them. Sometimes some combination of these entities. It depends what's the end result we want. I tell my clients that all of this stuff is more like salad instead of like a meal. So people treat it like a meal, like some sort of like, package number one or package number two. And if you go with that thinking, most likely you are making a wrong decision. But if you treat it like a salad where you get to pick, so you might say, well, what are you saying, Deepak? If I have a small business, you're telling me that I need all four entities? And yes, you may. You may need all four entities. Why? Because some expenses I can write off in C Corp. Some expenses I can write off in S Corp. Some expenses I can write off in sole prop. It just depends what kind of business you are in. Is the spouse involved? Are the kids involved? How much income there is? What your retirement plans look like? Are there going to be employees? Not going to be employees? Do you own any other business? I mean, those are just some ideas. I can go on. That will probably make this video a 2 hour long video. There's no end to it. And that's why, a lot of people come to me for comprehensive consultation that typically takes 4 or 5 hours. And by the way, if you're a coaching member, if you're part of a coaching program, you get the comprehensive consultation for absolutely free. So we can spend 6 hours, 8 hours, 10 hours, whatever it takes to make sure that you get your questions answered. But I thought I'd just share this video. So next time you watch a video or you hear from somebody and they try to enforce one thing on you that, hey, this is the best thing. In matter of fact, if you take a look at this program, the way we design it, it does tell you that this is the best option. Don't get tricked. This is just a programming that is designed to make it look like this is best. That may not be the best. You never really know until we talk to you, until we understand your situation, we understand your business, we understand your expenses. Then, only then, we can come up with the right solution for you. All right, guys. So that is for today's video, but I hope you find it very helpful. If you want to get hold of me, just go to taxcodeadvisors.com and just reach out to me from there. Thank you so much, and I'll see you next time.